Hello and welcome to Martyn Lucas Investor. We are here for the Bank of America earnings. We've got some special, potentially some very special announcement coming from Bank of America in regards to a Ripple partnership. We can be seeing a XRP usage from Bank of America as well, and also talks about tokenizations and stablecoins, all coming up shortly. This is a very important video that can tell us what's upcoming in the earnings. This is a CEO. We're going to play it once again. Hopefully they don't take us down again. And let's see what this CEO does say about Bank of America and their usage of XRP, because this is very important.
Things.
Another one you like is Ripple. You said it is the coin to be looking at right now.
Absolutely.
Why?
Okay, so Ripple actually was the second largest coin prior to the SEC's investigation of them. They did this really weird lawsuit against them, and basically the Ripple is going to be the track that everything's going to be running on in the future. So they created their own stable coin right now.
Okay.
And Bank of America, like I said, they were doing 100% of their internal transactions. They've got 83 different patents on it, and there's some incredible stuff that's going to be coming out.
So you heard it there first. Again, if anyone's having issues, please refresh your stream. Everything should be fine now. You heard it there first. Lots of patents. The payment rails could be running on Ripple, and also about 100% of internal transactions. Bank of America is already using XRP, according to the CEO. So let's see if the earnings will confirm that, if they make any major announcements like that. So let's get ready for that. We've got the earnings upcoming. It hasn't started yet. We'll come on to that. But we've got our very own newsletter. It's the first link in the description. Every single day we bring out the top stories, today's deep dive, and you should read about it more. It's in the newsletter. It's the first link there. There is no issues with the microphone. Someone says that. I think we are running all okay. The XRP according to... Yeah, please just refresh your stream and you will be fine. So Bank of America is the second largest US bank, played a central role in the Federal Reserve multi-year rehearsal and the conversion program. With ISO 2022 now fully implemented, Bank of America's systems can transmit and reconcile enriched data across borders in real time. This infrastructure layer closely complements distributed ledger systems such as RippleNet, which supports ISO 2022. They've had a massive beat on earnings today. Are they going to be announcing that they've been using the new ISO system alongside XRP and Ripple systems to make themselves more efficient? Well, we'll find out in about 5 minutes' time. And provides instant settlement through XRP, eliminating the need for pre-funded Nostro accounts and manual reconciliation. Bank of America reports earnings today. Analysts will focus on management commentary and digital infrastructure, tokenization, and payment modernization. With the US financial network now ISO 20022 enabled, Bank of America's next steps could determine how the bank plans to leverage its upgraded systems and potentially include blockchain-enabled settlement mechanisms. I'm going to have to skip through a little bit of this newsletter. I recommend you go and read it all, because we're about to start the earnings in 2 minutes' time. The Ripple and Bank of America do have a relationship. Not many people know about this, but they do. In 2020, a Bank of America banking strategist in a Bank of America banking strategies podcast, Bank of America's then head of global banking, Julie Harris, confirmed that the bank has integrated Ripple's technology within its payment architecture, describing it as part of the institutional client connectivity toolkit. They are working with Ripple. There's no doubt about that in my mind. Also, the bank has filed more than 80 blockchain-related patents, including several describing real-time distributed ledger settlement. To me, that sounds like Ripple. Systems that closely mirror RippleNet's design. Although there are no public disclosures confirming live XRP usage, Bank of America's repeat pilot involvement and participation in Ripple standard group suggests active evaluation of the technology's scalability within regulated frameworks, and the regulation is now here. Why Bank of America is unlikely to create its own XRP or stablecoin. This is an argument some present. I'll read this to you later, because I don't think that is what's going to happen. BlackRock's Larry Fink came out yesterday and talked about tokenization. Remember, he is going big on that as well, even though he was very anti-crypto and tokenization before. Now he understands it. Now he's going all in. So we're expecting something similar from Bank of America. They're about to start. So let's see if they've started. Let me unmute it. They've still got their music playing. We'll come back to that once they've started. We've got price targets around $56 for Bank of America stock. If you are interested as well in the stock themselves, I'm more interested in what they have to say about Ripple, because that means a lot more. So here we go. We're starting the earnings call now. Stay with us.
To all sites on hold, we do appreciate you.
They've started the call, but they've still got their music going. They will turn that off in a second. We do appreciate your patience and ask that you continue to stand by, is the last thing they said. So we'll stand by waiting for that call to start. Remember, this is all live as we speak. So let me just see if I've got, I want to talk to you about one other thing. I do want to play this Larry Fink interview, but I'll play that after the earnings, because the earnings, they are now late by a minute. They're not normally this late. So we'll see how long we have to wait. I would imagine they'll be live in the next 30 seconds. Let's wait and see if they are going to start anytime soon. I think they should be live very shortly. Let me just keep this playing. No, they've still got that music going. That means they are now late by over 1 minute. This is very strange. Bank of America is normally on time. Oh, we might have them. No. Nope, still nothing. They're very late now. No, we're still waiting for Bank of America to start. What I can do is possibly refresh this. Maybe their presentation is now live. Here we go.
Thank you for joining
there we
us
go.
to
We're starting
review our
now.
third quarter results. Our earnings release documents are available on the investor relations section of the bankofamerica.com website. Those documents include the earnings presentation that we'll make reference to during the call. Brian Moynihan will make some brief comments before turning the call over to Alistair Borthwick, our CFO, to discuss more of the details in the quarter. Let me just remind you that we may make forward-looking statements and refer to non-GAAP financial measures during the call. The forward-looking statements are based on management's current expectations and assumptions.
Do stay with me. I'll be looking at the XRPs.
Laid out.
He's just saying some regulation things. I'll be looking at XRP's price. I'll be analyzing it afterwards. We're going to have the full analysis. I'm going to give you my thoughts and opinions. We'll see if they're going to mention XRP Ripple, or they're going to hint at it throughout this call. So stay with us throughout the call, and we'll be looking at the charts as well.
Reconciliations to U.S. GAAP can also be found in our earnings materials and are also available on the website. With that, Brian, over to you.
Thank you, Lee, and good morning, and thank you all for joining us. Bank of America delivered a strong third quarter with good growth both in the top line revenue and bottom line EPS, all driven by strong operating leverage. Our ROTCE improved to 15.4%. This quarter's results provide good momentum as we finish 2025 and head into 2026. We have been demonstrating consistent organic growth for many quarters. This quarter's results highlight the continued organic strength of our world-class deposit and lending capabilities. Our results also underscore the benefits of a diversified business model with top-tier position not only in lending and deposits, but also across the markets-driven businesses in wealth management, global markets, and global banking. Before I turn it over to Alistair, I'm going to hit a few highlights here. We reported revenue of $28 billion, up 11% year over year. EPS was $1.06, up 31% year over year. We drove operating leverage of 560 basis points in the quarter. The efficiency ratio fell below 62%. The return on assets reached 98 basis points. And during the quarter, we returned to our shareholders $7.4 billion through dividends and share repurchases. Net interest income on an FTE basis reached a record $15.4 billion. That was supported by strong commercial loan and deposit growth, along with continued balance sheet positioning. Investment banking fees exceeded $2 billion, up 43% year over year. Our team in sales and trading grew revenue 8%, marking our 14th consecutive quarter of year-over-year revenue growth. Our asset management fees increased 12% compared to last year. All the business segments contribute to earnings improvement and had growth in earnings. Two stood out this quarter. Our consumer banking team delivered $3.4 billion in after-tax earnings, up 28% year-over-year, with 600 basis points of operating leverage. This reflects strong revenue growth and disciplined expense management. This business is driven off the core operating accounts of our consumer customers, and we gained more of them this quarter. These accounts have strong balances per account. The customers give us great customer scores, and we operate them at lower costs with more primacy in the account and lower attrition compared to anyone in the industry. That is a winning combination. Our global wealth and investment management teams posted net income of nearly $1.3 billion, up 19%. That was driven by the strong Merrill and Private Bank advisor productivity and the concomitant continued growth in fee-based assets. Lending in this business was particularly strong, with $12 billion in loan growth in this quarter. GWIM also opened another 32,000 banking accounts and grew deposits $3 billion from quarter two. As we look ahead, we believe this quarter's performance continues to reflect the impact of the investments we have made on a continuous basis for many years in technology, talent, and client experience. These continue to translate into strong financial results. We have been growing loans with the right risk and deposits as we continue to gain market share through organic growth. That translated into continuous NII improvements and complement our growth in our fee-based businesses this quarter. I also, as usual, commend you to look at the digital slides in the appendix on slides 20, 22, and 24. They show the continued progression across all the businesses of applied technology.
Everything flat right now. Bank of America up. We're waiting for comments.
I know the things we give you the stats. What you'll see in these slides is the customer-facing activities of Erica, for example. There are many other applications of AI going on in this company, but this one has been handling successful interactions for years with scale, and that application has now been applied across other businesses and even across our employee base. So we're confident in our trajectory of our results, and we're excited about the opportunities ahead. We look forward to talking to you at Investor Day in November. I'm going to turn it over to Alistair to walk through the financials in more detail.
Thank you, Brian. And I'm going to start with slide 3 to begin our discussion. And I just have 3 things on the income statement that I want to add to Brian's comments. First, we're pleased with the continued demonstration of expense discipline across our businesses. So in the third quarter, we delivered 11% year-over-year revenue growth, significantly outpacing 5% expense growth and resulting in that strong 6% operating leverage. Of the $28.2 billion in total revenue, an aggregated amount of $11.3 billion came from our sales and trading, investment banking, and asset management fees, 3 of our more highly compensable market-facing areas. So those areas grew 15% year-over-year in the aggregate, and we're excited to continue our investments given their strategic importance and attractive returns.
Everyone hit the like button and subscribe, please. We're waiting for comments on XRP and Ripple.
Revenue growth helps frame the 5% expense growth even better. Importantly, expense growth versus the second quarter was held to under 1%, while those same compensable revenue streams grew 8% sequentially, further reinforcing our ability to scale efficiently and invest where it matters most. Second, provision expense improved this quarter, with net charge-offs declining 10%, and we had a modest reserve release as a result of both credit card and commercial real estate improvement. The strong asset quality reflects the continued strength of our credit portfolio, years of disciplined risk management, and higher growth of the portfolio than other banks with good credit results. Lastly, our average diluted share count declined by 24 million shares from the second quarter, and this quarter included the dilution we've highlighted before in our filings, and that comes from our 2008 issued convertible preferred Series L stock. On slide 4, you'll note the various earnings highlights Brian and I have talked about. I don't have much to add here and would instead spend just a moment on our continued organic growth, which is powering our loan and deposit activity. We added new clients and we deepened relationships with existing clients. And across consumer, wealth, commercial, and institutional businesses, our teams are winning in the marketplace by putting our clients first. As always, we highlight the continued organic growth across each of our businesses, driven by client engagement, disciplined execution, and strategic investment. And you can see the results there on slide 5. Consumer banking continued to show strong momentum. We grew another 212,000 net new checking accounts, extending our string of consecutive growth to 27 quarters. This includes the 4th consecutive quarter of increased average non-interest-bearing deposits. And those are important because they are the primary operating account for a relationship, and they're quite beneficial as a low-cost funding source. Additionally, card, home, and auto loan balances grew year over year, reflecting healthy consumer demand. And we believe those further cement the relationship beyond just the operating account alone. In small business, we continued our string of lending growth, and we remain the number 1 leading provider of credit to small business in the United States. Global wealth and investment management saw client balances climb to more than $4.6 trillion, driven by strong AUM flows of $84 billion in the past year.
This is still live. I'm letting it run in the background. I've just muted it. I just want to welcome everyone into the show. Please do hit the like button, subscribe. We are waiting probably till the Q&A section. Maybe they'll announce it before, but in the Q&A section, we're waiting to see if they confirm those 80 patents they have, if they talk about the using XRP and Ripple. And we have got rumors of 100% of internal transactions are using XRP within Bank of America. They might confirm it. Their earnings is up today. ISO was last quarter. So we're now going to see if they've been using XRP within Bank of America. This will be a massive story if they have, so stay with us, hit the like button, subscribe. Let me take you back to it. We're still live. I just muted it because it was the boring numbers part, but it will get more exciting towards the Q&A where they'll probably announce it.
From healthy demand of our clients. Let's transfer to a discussion of the balance sheet using slide 6, where you can see total assets ended the quarter at $3.4 trillion. That's down $38 billion from the second quarter, as good loan growth was offset by lower global markets assets and wholesale funding reductions as part of our plan to continue to tighten the balance sheet. Importantly, this balance sheet tightening will continue to benefit the net interest yield, NIY. Deposits ended just over $2 trillion and were up $72 billion from the year-ago period, with growth in both interest-bearing and non-interest-bearing deposits. Average global liquidity sources of $961 billion remain strong. And shareholders' equity of $304 billion was up $4.6 billion from last quarter as we issued $2.5 billion of preferred stock. Otherwise, a $2 billion increase in tangible common equity to $208 billion included a modest capital build as net income was slightly more than capital distributions, and we saw some improvement in AOCI. We returned $7.4 billion of capital back to shareholders, with $2.1 billion in common dividends paid and $5.3 billion of shares repurchased. Tangible book value per share of $28.39 rose 8% from the third quarter of 24. Looking at regulatory capital, our CET1 level increased modestly to $203 billion, while the risk-weighted assets were relatively flat, and that drove our CET1 ratio higher to 11.6%. This is well above our October 1st 10% regulatory minimum. Our supplemental leverage ratio was 5.8% versus a minimum requirement of 5%, which leaves capacity for balance sheet growth, and our $473 billion of total loss-absorbing capital means our TLAC ratio remains comfortably above our requirements. On slide 7, we show a 10-quarter trend of average deposits to illustrate the extension of consecutive growth across those periods. Average deposits were up $71 billion, or 3.7% from the third quarter of 24. Average consumer deposits were up 1% year over year, while global banking deposits grew 15% compared to a year ago. Our global capabilities, digital solutions, and relationship managers continue to win clients in the marketplace. In addition, we remain disciplined on pricing to achieve that growth. Overall rate paid on total deposits declined 32 basis points year over year, reflecting both lower rates and disciplined actions in our global banking and wealth management businesses. rate paid on the roughly $950 billion of consumer deposits remained low at 58 basis points in Q3, driven by the operating nature of that account and client base. Compared to the second quarter, total deposit rate paid rose 2 basis points due to mix shift into interest-bearing, and we expect improvement next quarter.
XRP going sideways. It's coiling up, in my opinion. Again, I don't know if it's going to pump or not, but it's coiling up for a move.
Let's turn to loans by looking at average balances on slide 8. You can see loan balances in Q3 of $1.15 trillion, improved 9% year over year, driven by 13% commercial loan growth. Consumer loans grew at a slower pace, and importantly, were up across every loan type. For the second consecutive quarter, every business segment recorded higher average loans on both a year-over-year basis and on a linked quarter basis. Focusing on commercial loans in global markets, we continue to take advantage of the strong financing demand in the marketplace from institutional borrowers, where we lend against diverse collateral pools. Small business is benefiting from our newly combined local market-based coverage model for small business and business banking, and that's creating more capacity for client expansion. And lastly, note the 9% improvement in wealth management as affluent clients borrowed for investments in assets like sports and arts and businesses. So all of that balance sheet activity across deposits and loans results in net interest income. And let's turn our focus to NII on slide number 9. On a GAAP, non-fully taxable equivalent basis, NII in Q3 was $15.2 billion. On a fully taxable equivalent basis, NII was a little less than $15.4 billion, and as I said earlier, that's up 9% from the third quarter of 24. NII grew $1.3 billion year over year and $572 million on an FTE basis over the second quarter, driven by higher loan and deposit balances and benefits from fixed-rate asset repricing. And versus Q2, we also gained an extra day of interest. The net interest yield improved 7 basis points from the second quarter, reflecting the growth in NII, while the earning asset balance modestly declined as loan growth replaced lower-yielding securities and global markets balances declined modestly. And as I said, we reduced expensive wholesale funding and cash. Regarding interest rate sensitivity, on a dynamic deposit basis, we provide a 12-month change in NII for an instantaneous shift in the curve. So again, that means interest rates would have to instantaneously move another 100 basis points lower than the expected cuts that are already contemplated in the curve. So if you think about that, 100 basis points below what the curve implies, more simply put, that would mean, for instance, on the short end, the July Fed funds rate next year would be getting down to 2.25%. So on that basis, a 100 basis point decline would decrease NII over the next 12 months by $2.2 billion. And if rates went up 100 basis points, NII would benefit approximately $1 billion. With regard to a forward view of NII, let me give you a few thoughts. In January and again in April, we provided our expectation that we could exit Q4 of 2025 with NII on a fully taxable equivalent basis in a range of $15.5 to $15.7 billion. We also noted our expectation for that growth to accelerate in the second half of 2025. Despite all the uncertainties we've experienced around tariffs and rates, we've seen good performance against our expectations. And even with the third quarter, late quarter interest rate cut, and with the curve anticipating 2 more cuts in October and December, we believe fourth quarter NII will be in the higher end of that range of expectations. So think of that as being $15.6 billion plus on a fully taxable equivalent basis. And that would represent approximately 8% growth from the fourth quarter of 24. Thinking a bit more generally, we just note for the full year of 2026, our expectations about the drivers of growth are largely aligned with 2025 performance. We expect good core NII performance driven by core loan and deposit growth a little bit above GDP, which will additionally benefit from sizable fixed-rate asset repricing. And in 2026, we expect to see roughly $10 to $15 billion in combined quarterly mortgage-backed securities and mortgage loans. Those will roll off, and they'll be replaced with new assets at 150 to 200 basis points higher yield. That should result in full-year NII growth somewhat similar to
going up slightly now.
Performance over 2024. So think of that as something like 5 to 7% growth. Okay, let's turn to expense, and we'll use slide 10 for the discussion. First, I just want
talking about expense for a second. So I'm just want to remind everyone, thank you for tuning in. Make sure you hit the like button. Make sure you subscribe. We're waiting potentially towards the end of the call, which might be in about 20, 30 minutes, where they start talking about Q&A, tokenization, XRP partnerships, confirming that 100% of their internal uses transactions used XRP. We're waiting for any glimpse of that. And if that does happen, that would be a monumental moment. So let me go back to the earnings call. This is live. We're watching it all together. Thank you for tuning in.
Roughly in line with Q3. As you know, headcount's the key driver of expense, from compensation and benefits to occupancy costs and technology. And we manage this closely, not just in total numbers, but also in organizational structure, ensuring we're striking the right balance of managers and teams. And the good news is we continue to manage headcount well. So looking at the past 3 years, we've been able to lower our headcount from a peak of 217,000 to 213,000 now. And more recently, since the third quarter of last year, we're down 500, which includes the addition last quarter of nearly 2,000 plus college grads. And it's this disciplined approach that supports both efficiency and growth. So let's now move to credit and turn to slide 11. And you can see asset quality remains sound with improvements in several key indicators. Net charge-offs were $1.4 billion, down about 10% from the second quarter, with the improvement split pretty evenly between credit card and commercial real estate. The total net charge-off ratio this quarter was 47 basis points, down 8 basis points from Q2. Q3 provision expense was $1.3 billion and mostly matched net charge-offs. We had a modest reserve release associated with improved outlooks for both credit card and commercial real estate. Focusing on total net charge-offs again, and looking forward, in the near term, we would not expect much change in total net charge-offs, given the steady consumer delinquency trends, stability of C&I, and reductions in CRE exposures. On slide 12, in addition to the improvement in consumer losses, note the reductions in both reservable criticized and non-performing loan metrics commercial portfolios. Non-performing loans are down 19% from Q2, and reservable criticized exposure in commercial real estate is now down nearly 25% from the third quarter of 24, as we dealt with the more problematic exposures across the year. Let's turn to the performance across our lines of business, beginning with consumer banking on slide 13. Consumer banking delivered strong results, generating $11.2 billion in revenue, up 7% year over year, and $3.4 billion in net income, or 28% growth. Return on allocated capital rose to 31%. These results reflect the value of our deposit franchise, underscoring both the breadth of our platform and the success of our organic growth strategy and digital banking capabilities. Innovations such as family banking, our high-value cashback credit cards, and our industry-leading preferred rewards program are delivering differentiated value to clients and value we believe is unmatched elsewhere. This client value proposition, combined with disciplined pricing, helped drive a 9% year-over-year increase in net interest income. Another strong highlight this quarter was expense management, which enabled us to deliver more than 600 basis points of operating leverage. Continued innovation and the deployment of advanced technology and tools helped us to hold expense growth to just 1% year over year, while revenue grew significantly. As a result, our efficiency ratio improved, falling below 50% for the quarter. We continued to invest in high tech, which drove higher digital engagement, and we continued to invest in high touch, We continued our march into new markets, filled out more of previously expanded markets, and supported our brand in those communities. As an example, we just opened 4 new financial centers in Idaho over the past 6 months, expanding our presence and complementing our existing Merrill team in the local market to better serve clients in that.
This is still running live, but they're not talking about new technologies yet. I've seen a lot of people in the chat. Someone said this is boring. Well, unfortunately, investing is boring. You need to listen to these earnings calls so you're ahead of the game. A couple of people have been saying they've got liquidated and they've lost all their gains. Well, I will talk to you about where I think XRP is going, how to deal with the losses, what to do next. Again, not financial advice, but I'm going to give you my own experiences and how to come back from that massive crash we saw on Friday. So do stay with me until the end. We might even get a surprise massive announcement from Bank of America on this call. If you take a second to hit the like button, that would be great as well. Let me go back to the earnings call. It's still live. I just muted it while they're talking about this.
Is credit card, and our loss rate decreased from 3.82% to 3.4% linked quarter. This contributed to an improved risk-adjusted margin on credit card, approaching 7.5%. Finally, as shown on appendix slide 20, strong digital adoption and Erica engagement continues, and customer experience scores remain elevated, reflecting the impact of our ongoing investments in digital capabilities. Turning to wealth management on slide 14, the business delivered a strong quarter marked by improved profitability. Net income grew 19% year over year to nearly $1.3 billion, driven by new household growth, strong AUM flows, loan growth, and disciplined expense management that produced meaningful operating leverage and a 26% return on allocated capital. We achieved 300 basis points of operating leverage, which contributed to a 27% pre-tax margin, an improvement of over 200 basis points. Together, Merrill and the Private Bank managed $4.6 trillion in client balances and continued to generate organic growth with $84 billion in AUM flows over the past year. This reflects a healthy mix of new client assets and existing clients putting more capital to work. During this past quarter, Merrill and the Private Bank added 5,400 net new relationships, with the average size of new relationships continuing to grow across both businesses. And importantly, we're not just adding relationships, we're deepening the ones we enjoy already. And reflecting the strength of our integrated model and our product offering, the percentage of clients with banking products continued to rise, and it's now at 63%. In the third quarter, GWIM reported record revenue of $6.3 billion, up 10% year over year, led by a 12% increase in asset management fees. Loan growth remained strong, and we saw a notable pickup in custom lending, with both volume and loan size increasing, and that drove a 9% year-over-year increase in average loans. Finally, I'd highlight the continued digital momentum as shown on slide 22. New accounts are increasingly being opened digitally, underscoring the effectiveness of our digital investments and the evolving preferences of our clients. On slide 15, you see the results for global banking, which benefited from improved investment banking activity, significant deposit growth, and solid loan performance. In Q3, global banking delivered net income of $2.1 billion, up 12% year over year, supported by 500 basis points of operating leverage and a 17% return on allocated capital. The standout driver of performance was a 43% year-over-year increase in firm-wide investment banking fees, which fueled 7% overall revenue growth. Firm-wide, investment banking fees rose across the solution set. Advisory was up 51%, debt underwriting increased 42%, and equity underwriting grew 34%. We maintained our number 3 position year to date, and we also gained market share during the quarter. Notably, we participated in several of the industry's largest transactions, a clear testament to the value clients place on our financial advice and solutions. Non-interest expense grew compared to last year as we continue to invest in the future, and average deposits grew 15% year over year, contributing to a 6% increase in global transaction services revenue. And importantly, Disciplined pricing coupled with lower rates led to a 47 basis point decline in rate paid compared to a year ago. Switching to global markets on slide 16, I'll focus my comments on results excluding DVA, as we typically do.
Cross-border payments, potentially?
We extended our streak of strong revenue and earnings performance and once again achieved a solid 13% return on allocated capital. In the third quarter, global markets generated net income of $1.6 billion, up modestly year over year and consistent with the prior quarter. Revenue, excluding DVA, grew 10% year over year, driven by strong sales and trading performance and the benefit of higher investment banking revenue shared with global banking. Focusing on sales and trading, revenue ex DVA rose 8% year over year to $5.3 billion. FICC revenue grew 5%, driven by improved performance in credit products. Equities trading led the improvement, with 14% revenue growth supported by increased financing activity in Asia. Expense growth year over year reflects both the revenue increase and higher trading-related costs in certain Asian markets, and those costs are passed through to clients and therefore appear in both the revenue line and the expense line. As noted earlier, we continue to benefit from lending opportunities tied to highly collateralized pools of high-quality assets, and clients value our expertise and the liquidity we provide in delivering these solutions. On slide 17, all other shows a loss of $6 million in the third quarter, with very little to talk about here. Our third quarter effective tax rate was 10.4%, and excluding the tax credits related to investments in renewable energy and affordable housing, and a small amount of discrete items, the effective tax rate would have been much closer to a normal corporate tax rate at approximately 23%. So thank you, and with that, we'll jump into the Q&A.
Q&A time. Get ready, hit the like button, subscribe. This is when it gets interesting. People are going to ask about tokenization. People are going to ask about crypto. They might mention XRP. Get ready, hit the like button. Let's get ready for the Q&A.
We'll take our first question from Glenn Schorr with Evercore. Your line is open.
Hey, Glenn.
Hi, thanks
Glenn, before you start, let me just say, it seems like one of the phone lines may have cut out at some point during the call, but the webcast was working throughout. So just a reminder that the website will have the replay of the call in case you were on one of the lines that might have had a break in it. So, Glenn, go ahead.
No problem. So, Alistair, I heard your comments on the expense message for the fourth quarter. So appreciate that. I guess I have a bigger picture AI question of, okay, big banks still you're ahead of the curve in terms of digitizing the whole franchise, but with the infusion of AI throughout the organization, and you still have big manual functions throughout the firm, why aren't you and others talking about AI as a huge efficiency driver of better margins in the years to come? Is it just a little too far off? Am I a little too optimistic? I'm just curious on that front. I think, your operating leverage is great. I'm not talking about that. I'm just talking about AI's potential in general.
So I think, Glenn, it's Brian. Good to hear your voice. Look, we believe applied technology, which is a range of outcomes from the digitization that we show on those pages in 2022 and 24 over the period of time, and the customer adoption of technologies and interfacing with our company and technology always provides that. So we had 285,000 people 15 years ago. We have 213,000 people. 3 years ago, we had 217,000 people after the pandemic and all the manual stuff we had to build up. We've worked that back down. So we believe strongly that all technologies help drive that, and this technology and artificial intelligence allows you to do things that you heretofore haven't done. And so I think the question is just, it's to put it in place, you have to have your data appropriately arrayed. You have to make sure the models are going to give the right answer. It has to be in a controlled environment, because in a regulated institution like ourselves, we don't, we don't get it, excuse saying the model said it. Sorry, it has to be right. And so if we turn down a mortgage loan under automated underwriting, we're liable for the outcome irrespective of how we did it. So we're seeing it go everywhere, and the volumes of activity of the company have gone up huge since that period of time where the headcount has come down by a lot. And so we continue to apply it. What I'd look at carefully on those pages is things like on the consumer page, you'll see Erica interactions building up and Erica users building up, and we've gone from 210 questions that could be answered to 700. But just to put that in context, in the last 24 hours, there were 2 million interfaces where a consumer got an answer from Erica in our company, and that same technology is applied in the institutional basis. I think you can see that on page 22 if I'm right, or maybe 24, but you can see that Erica in the institutional, lot smaller number of customers, but rising very fast. So that's just one model. We have models all over the company. So we believe strongly that this will have an impact. We will continue to manage it, but the implementation, these are not proofs of concept and things like that. They're past tense things happening. 2 million customer interfaces yesterday, so this isn't something to come. We've been at it a while. But I think the idea of it providing constant leverage and constant reinvestment with the same expense base is really what we're after, and then grow the revenue faster, continue to take market share. So its impact on expenses is felt. We are reinvesting some of that to actually grow faster, and you're seeing the results of that.
Okay, so that more revenue and same expenses would still bring us better margins in the future. That's really where I'm going. Sounds like you agree, but you don't want me to pin you down on a point in time.
Yes, I think to say this will happen next week or the week after, you have to be a little careful because we have to get it right. That model took us years to perfect. It's not something you can snap your fingers at and make happen. And it's a human being change too. So stay tuned. We'll give you more of that broader. We'll have the experts talk to you in early November. But it's here. It's working. I'm proud of the team for taking it to implementation across the board. But it allows us to continue to manage this company with just in the last 5 years, we have 20% more core checking holders in consumer than we did 5 years ago. Think about that. In consumer checking balances are up by 50%, 50% in that time. Think about the leverage in that, and that's why the consumer kicking in as the NII kicks in, you're seeing them have such good year-over-year results.
Okay, I appreciate that. Thank you.
We'll move next to John McDonald with Truist Securities. Your line is open.
Hi, good morning. You guys had good results across all your capital markets businesses, sales and trading, IB, wealth. It's always hard to have an outlook here, but just wondering broadly how you're feeling about the environment, pipelines, and investments made in those businesses against what's usually a seasonally slower fourth quarter and coming off such a strong 3Q.
Thanks, John. I'll start with investment banking. We've obviously seen a pickup in activity here in the third quarter. We were happy to see that. As we've seen more certainty now around trade and tariffs and around taxes as well, it's allowed our client base to make longer-term decisions, and that's reflected in our investment banking activity. In terms of the pipelines, they're up this quarter, up over double digits, so we feel good about the pipeline and the way it's developing. And, we'll need to see how the transactions execute in Q4, but it feels like a good environment in terms of, for example, M&A at this point. Around the global markets business, we've obviously invested significantly there, just as we have in investment banking. I should go back to investment banking and the investments we've made there. We've always profiled the investment we've made in middle markets and in international and in earlier stage, faster growing economies. So that's been a big part of our investment banking growth in the course of the past year or so. When we get to sales and trading, we've obviously invested a lot there in terms of technology and people and balance sheet. Normally, Q4, you see a seasonal impact from client activity slowing as you move into the fourth quarter. That would be pretty normal. But the constructive environment for the sales and trading business remains as investor clients continue to reposition based on rates and policies as they develop around the world. So it feels like a continued constructive environment for the global market sales and trading business.
Great. Thanks, Alistair. And just also, you mentioned deposit beta. What are you expecting for deposit beta across your various businesses if we continue to see the Fed moving rates down?
Well, I think you'll see us do the same thing we've been doing. In the wealth business, obviously, we tend to move with money market rates. Those tend to be a full pass-through. So in the wealth business, I'd expect us to fully pass through rate cuts from this point forward. And around global banking, while we always do it on a client-by-client basis, particularly around interest-bearing, we'd expect to pass through as the rate cuts develop as well. So I'd expect you to see us with the same disciplined pricing on the way down as we offered on the way back up. And the only thing I think you just have to...
Any second now, they can be talking about XRP, Ripple, stablecoins, crypto, tokenization. So stay tuned. Any second now, it could be the next question.
We'll take our next question from Jim Mitchell with Seaport Global Securities. Your line is open.
Hey, good morning. Alistair, you noted you took down more expensive wholesale funding on the liability side, which kept the balance sheet relatively flat, which seems more NIM accretive than NII accretive. So the question, I guess, is how many quarters of that do you expect, and what sort of earning asset growth should we expect over the next year or so?
Yeah, so we've talked about that would be a focus for us over time. When people ask us about net interest yield, we try to explain it's going to improve over time based on two things. First is net interest income is going to continue to increase. And the second is the balance sheet we don't think will grow quite as fast as the loans and deposits grow. And that's because there's still some more wholesale funding that we can pay down. As you point out, it doesn't cost us anything in terms of NII, but it is net interest yield accretive. So we've got a little bit more of that to do. It won't be the major part of our NIY, net interest yield accretion, but I think you can almost think about it being kind of like 1% slower maybe over the course of the next year or so.
Okay, no, that's helpful. And then just maybe pivoting to capital, you guys, as you noted, you're well above your 10% minimum. Seems like we have GSIB surcharges likely coming down and other reforms. Why not? How do you think about the buffer where it is today, and what prevents you from taking that down a little bit? And if you have a longer-term target, that'd be great.
Our target will be, as we said before, Jim, sort of 50 basis points over the regulatory minimums. And so you should expect us to keep working that down. Interestingly enough, the ratios are flat this quarter because of the extra earnings and stuff. So we took $7.3 billion of capital and put it back in there. You'd expect us to continue at a good rate. And then through the good organic growth, which is what we use the capital for, we use up some of it, and then we'll continue to work it down if that organic growth isn't sufficient to use up the capital over the near term. We got to get these rules finalized so we make sure all the different, is it 10, is it 10.2 on the averaging? This is all flopping out there. You'd expect in the first half of next year. The intent is there. The outlines of rules are there. The adoption of the actual rules is what we want to make sure it gets through, and then we'll adjust. But our hope would be to grow our way through it, because then you'd see a lot more earnings. But if not, we'll just keep peeling down the capital.
Okay, fair enough. Thanks.
We'll move next to Erika Najarian with UBS. Your line is open.
Hi, good morning. You reported clearly a standout quarter with a ROTCE or ROTCE of 15.4%. I know I'm probably jumping ahead of what you plan to say on November 5th, Brian, but one of your closest peers, Wells Fargo, did put out a medium-term target of 17 to 18%. JP Morgan has had a 17% ROTCE target through the cycle for a long time. Given that you've hit this target now, should we presume that this is something that you could sustain over the near term and perhaps continue to work upwards or closer to those peer targets?
So, Erika, I think you should expect us to continue to walk our return on tangible common equity north from here. We plan
Last time we had a few questions on stablecoins and AI. I think this time we'll get a few questions as well. Will they mention XRP or Ripple? The likelihood's low, but if we catch it and they do say it, then the market can pump like we haven't seen XRP pump before. So let's wait. Let's see what the next few questions are going to ask. And I'm sure we'll get something crypto related, and if they do confirm their partnership with Ripple, then we can see a big price move on XRP. Again, it's never financial advice. Stay with me to the end and I'll tell you what if I think the bull market is going to continue. If we're in a bear market, I'll give you all the further analysis as well. So stay with us right now. This question isn't about the stablecoin or XRP. So if everyone could just take a second, it's absolutely free. Hit the like button and subscribe if you haven't done so before. Let's go back to the earnings call. This is live.
This is a two-part question. As we think about how you're framing that ROTCE walk in 2026, do you sort of plan to move away from the 1 to 2% expense growth and talk about efficiency instead? Or, is there sort of enough still identifiable inefficient expenses in the franchise that you could recycle and perhaps continue on sort of this lower sort of expense rate target?
I think, Erica, there's a lot of pieces of that, but the expenses in our company are driven by the numbers of teammates and then what we pay them. And so, our job is to keep using the technology, as I discussed earlier, that continues to allow us to do more with the same amount of people or less people, and then to pay those people more in relation to the productivity of the company. And so, yes, there's an embedded cost of teammates that grow, and we want it to grow because FA compensation grows, PCA, private bankers client compensation grows, investment bankers because that grows more directly in line with revenue. But think about it in a broad context. If we keep the headcount basically running flattish, the volumes across it, the NII across it higher, and the growth that's coming is through some of the markets-related businesses, and then managing headcount appropriately around in the back office and other types of things. That's good. What AI does is gives us a chance to manage some of the expense base a little differently going forward than we had in the past, which will be helpful. And so we feel good about that. Whether the idea is to grow revenue as faster than expenses and create operating leverage is a simple way to think about it. But it's complex. And then the actual efficiency ratio, remember, this gets down to comparisons between companies or business mix. So our wealth management efficiency ratio inherently is 74% at 26% pre-tax margin. Consumers at 50%. Banking is down below 50%. You got to sit how much your revenue is coming through the various pieces will determine the aggregate efficiency ratio. Our job is just to continue to improve it.
Improve from the 62%.
Yep.
Got it. Thank you so much.
We'll take our next question from Mike Mayo with Wells Fargo Securities. Your line is open.
Hey, Brian, you left me hanging with that last answer. When you talked about the efficiency ratio, you expect to improve. It was 65% last quarter, and 62%, and improve the efficiency ratio to what? Do we have to wait to November 5th, or is that something that is kind of not guide to, or and also in terms of, I'm just looking for some more meat on the bone, so to speak. I mean, I guess year over year, headcount's down 500 and revenues are up $3 billion. So I think that's kind of what you're talking about. But where does that eventually take you to, given your business mix?
Look, the question is, where's the revenue coming from for the next 4 quarters? NII is obviously much more efficient in a sense of cost because same loan balances, the same people producing additional credit relationships, the embedded cost of production and consumer for the million cards we do, new cards we do a quarter, the number one small business lender in the country and producing good growth there. That all falls the bottom line. The expense base is built to have that kind of activity growth. So we feel good about it. We'll give you more guidance, but at the end of the day, it'll be a result of where the revenue is coming from, especially in the markets business, and how much that impacts it. But you should be very confident, Mike, we manage expenses well in this company and the headcount well, and so we'll continue to do that.
Could you just give us a little bit more on AI? I mean, you're ranked top 10 globally as far as a bank and using AI and with your patents and everything else. And it's getting back to that first question on this call. How much savings do you have from AI? How do you measure those savings? What are some of the best initiatives you think you have? Or just help us frame how that could transform the company a little bit more, if you could.
Yeah, well, as I said, with a little bit more time to dedicate to that discussion, we'll have a panel of the experts show you what the work we're doing. But I'd make 3 or 4 points about AI. Our view of AI is it's enhanced intelligence that the teammates are going to be critical delivering the services, and therefore it's a enhanced intelligence, not an artificial intelligence. The second is it's not something to think about. It's something that happened. As I said yesterday, 2 million customer interactions were handled through the Erica platform just on the consumer side alone. So, and then the third thing is, we think the paybacks are coming in there, but what's interesting is that the places we can apply it are different than some of the other technologies we've had in the past. So, and we'll take you through that. So we feel good about it. It ought to help with the overall efficiency of the company, relative of human costs being 60-70% of our costs. But it comes with higher technology costs, higher work. So just in the coding area, we've saved about 10% of the aggregate amount of coders we have working, but we're dedicating that to drive more efficiency. So we'll take you through all that. It's exciting. It's not a theoretical question at Bank of America. It's an applied question at Bank of America. But you do have to be careful about extrapolating things that have to be done right in order to work. And the $3 billion we spent on data in sort of 2014 to 19 to get the data perfect in this company, or as perfect as we could. Perfect is beyond reach, but that kind of number has to be spent by competitors, and we've spent it, admittedly, for potentially a little bit different reason, but it takes that much work.
All right, I'll take that as a teaser for November 5th. Thank you.
Thanks.
We'll move next to Chris McGratty with KBW. Your line is open.
Oh, great. Good morning. On credit, overall, really strong results. I mean, under the hood, if we go a level deep, is there anything that's giving you a little bit of pause today versus maybe 3 to 6 months ago, and anywhere that you're not leaning into with the balance sheet, with the growth picking up, anywhere you're avoiding? Thank you.
Well, the broad outline is not yet, and no, meaning not yet. We haven't decided to change anything, and no, we're not really observing anything other than continued strong performance in the credit portfolios. So the results we reported today, you can see consumer charge-offs came down again, and commercial charge-offs came down again. Now, those commercial charge-offs are at a really, really low level. So credit remains in a good place. And we built this responsible growth strategy to do 2 things. First, to have a risk appetite that we're proud of through the cycle, and second, to deliver loan growth that exceeds the industry. So we feel like we're succeeding on both of those right now. Now, when you see headlines, do you immediately do a look across on everything? Yes. If something changes overnight, do we spend time as a team considering, is there anything we should be changing? Yes. But right now, the broad message we need to send to people right now is the credit portfolios are performing very well at this point.
So, Chris, welcome to coverage of our company. A core like this is salubrious in that, it shows you can both grow and do it the right way and have great credit results. So, and if you look beyond that, remember, our industry, the regulated part of our industry, the 30 banks or so, go through a CCAR test that you get to see the results on. They go through tremendous shared national credit depth of examinations you see. And so I think if you look at the statistics by our industry and our peers, they are in strong shape. And the comparisons to 2019 are interesting because that was like a 50-year low in our 50-year good, the best year in 50 years in our company's credit history. So we're comparing it to one of the best years. So we feel very good about it. We can both grow and do it with the right risk, and Alistair talked about that. So we're comfortable and we're pushing forward.
All right, great. Brian, Alistair, thank you so much.
Thank you.
We'll take our next question from Ken Usdin with Autonomous Research. Your line is open.
Hi. Good morning. Thanks. Just to follow on the loan growth side, just a lot of the loan growth you've been putting on in the commercial side, it looks like it's been in the market segment. And just wondering just how much both capacity you have to continue to build that part of the book, how much demand you're still seeing for it, and how you think about like the spreads and returns on that part of the business versus kind of the banking book growth.
Yeah. So in terms of capacity, we've got a lot. And I say that because obviously at $2 trillion of deposits and $1.15 trillion of loans, we've got substantial excess that we can provide for clients in the economy over time. So we've got a lot of capacity. In terms of demand, I'd say it's been reasonably robust.
There's only a few questions left. Last time we got a couple questions. XRP moved on price. They mentioned partnerships. They mentioned stablecoins. This time, it looks like they're not accepting questions like that. Let's see. There's a few more questions left. Even if we don't get it, I've got a lot of information I want to share with you after the call ends about if we're in a bear market, bull market, where I think we're going, the partnerships that are underlying. So stay with me. Few more questions left. Are we going to get a question that reveals it all?
To see that demand.
Remember, even if we don't, this is how we understand it. We look at bank earnings calls. We understand what the banks are doing so we can make more informed decisions. At the end of the day, Ripple XRP is working with the bank, so we need to understand what they're saying. Some people are a bit annoyed in the chat, but this is how you learn. So here we go. Let's continue.
We've been happy there. And then the only other thing I would just remind you is because these are often so well collateralized and structured, they're typically investment grade. They typically have better risk ratings than some of the lending that we do in other places. And our res crit and our net charge-offs in this area have been close to zero. So we've had terrific empirical performance from this portfolio over a long period of time.
Got it. Okay. And on the retail side, on the consumer side, looks like consumer deposits on average we're down a little bit sequentially. Just wanted to see what you're thinking about. I know that's been something that you've been looking for to get that mix going more towards retail deposit growth, and it's been a little bit more wholesale in the last couple of quarters. What are you seeing just in terms of when you expect that to inflect, and is it just people are putting money elsewhere, whether it's back in the markets or other places? Just your thoughts on retail deposit growth from here. Thanks.
Yeah, well, look, we're encouraged. If you look back to last year's third quarter, we're up. And we were up second quarter to second quarter. So a little bit of this is second to third quarter seasonality. We feel like we have inflected on consumer. So we're up 1% year over year. I think you're detecting from me, would we love to see more growth in consumer? Would we like to be back to the 4% plus that we typically enjoy? Yes, we would. But remember, we're coming off of a period where consumer deposits really had to normalize after pandemic. And it was important for us to get to the third quarter of 24, where it looks like we kind of bottomed out. Now we're a year further in, and we're growing the core. So you can see our non-interest bearing was up 1%. So look, we're not at this point. We're not chasing CDs, broadly speaking. So that's not where the growth is coming from. We're trying to make sure these are high quality operating deposits with the clients that really stick with us for the next 20 or 30 or 40 years. So that remains the strategy.
Yep. Alistair, I just said, if you look at page 19, lower left, you'll see that the growth, as Alistair said, the 1%, $9 billion from third quarter last year, this year, was all in the low interest and non-interest category, which is the more beneficial part of it. So go back to that 220,000 units of new checking primacy, new checking accounts that are all primary, that we focus on the primary account in the household. Think of that, compounding over the last 3 years. 750,000 new checking accounts per year that are 90+% primary in the household. The core transactional account. That's where we see that compounding in. Against that was sort of a buildup of some of the rate-seeking activity and a run down to that. And then secondly, against that, frankly, was the higher-end consumers moving their money out of inert lower-end stuff as rates rose that were behind. But if you look in the core bracket of consumer, they're actually growing the deposits in that business. In that
S&P 500 is going up a lot.
Okay, got it. Thanks.
XRP breaking down.
We'll move next to Matt O'Connor with Deutsche Bank. Your line is open.
Hi, good morning. Can you talk about how sensitive you are to lower, medium, and long-term rates? We've obviously seen, a decent drop here, just kind of in the context of the benefits from fixed-rate asset repricing and the 2.3% NIM that you've talked about looking at a couple of years.
Matt, I don't have a great deal to add to what I covered earlier. So, when we talk about that asset sensitivity of an instantaneous drop in 100 basis points at both the long end and the short end, it has an impact of $2.2 billion of net interest income. So that obviously
Stock
requires,
market's open.
Number one, it happens tomorrow. Number two, it exists all year. And number three, it happens at the short end and the long end all at the same time. So I don't know how you would assign a probability to that, but it's obviously on the lower end.
XRP reacting to no news from Bank of America. That might have been our last question. Stick around. Let's see. I've got the full analysis after.
You'd end up seeing probably 80% or so, because so much, obviously, of the company's balance sheet just reprices daily. And then the longer end is probably 20% of the sensitivity, and that tends to be the fixed-rate asset repricing. Then the question becomes, if you've got fixed-rate asset repricing over many, many years, obviously it can impact positively or negatively, depending on where rates go and bounce around over that period of time. So we'll have plenty of time to guide you, I think, each quarter as we go through, and we can share with you what's actually happened with rates and then what that means looking forward.
Okay, and then just on this kind of more medium-term NIM outlook that you've talked about, 2.2%, sometimes it's 2.2, sometimes it's maybe a little bit higher depending on the mix of earning assets and growth. But just any updates on that as you think about the medium-term NIM outlook? Thank you.
No update other than we're one further quarter into that march. We added 7 basis points this quarter. We're up over 2%, and the team and I know what we need to do. We just have to keep going.
Okay, thank you.
We'll take our next question from Betsy Graseck with Morgan Stanley. Your line is open.
Hi, good morning.
Morning.
So, Alistair and Brian, I wanted to make sure I got the guidance right here. First off, on the NII, as you're thinking about 2026, highlighting that the inputs are similar to this year, and you indicated 5 to 7% up, NII 26 over 25, is that right?
Yeah, and the background there, Betsy, just so you know, is we're obviously going to get pretty good core growth from just the organic behavior of the clients and adding some over time. So think about that like 4 to 5%, and then you get a little bit of boost from fixed rate asset repricing. You got a little bit of rate cuts in the future, but when you add all that together, we feel like it's probably something like 5 to 7%.
Okay, great. That was what I was wondering, if it's just NIM or is that NIM plus volume, and it's all in holistic. Okay.
Yeah, and again, here we are. It's whatever it is, October 15th. So as we go through time, we'll be able to update you more. And I think we'll give you a sense also at Investor Day of how that plays out over the course of multiple years, because obviously we're going to get this asset repricing over multiple years, and we're going to benefit from that.
Yes, of course. And then more near term, there was a comment you made about expenses being flat in next quarter versus this quarter.
Yeah, I think I said we thought they'd be flattish because we anticipate the headcount is going to be flattish. And then it's just a question of what happens with the revenue side.
The headcount would be flattish. Okay. But I wanted to get a sense as to, how are you thinking about NII and fees on the back of that? Because, the question that's coming up is, hey, you're guiding down for next quarter on expenses coming in, flattish not coming down. But I'm wondering, what's your expectation for capital markets and other compensatory revenues? Because I think we would like to hear the whole picture, not just one piece of the income statement outlook.
Yeah, so let me try to reframe. On the expense side, what I'm trying to communicate is the overall expense base for the company we expect to be kind of flattish for the fourth quarter, because the headcount's flattish. We can just see that. That's where it is, and that's the biggest part of the expense base of the company. Now, Obviously, we have to watch and see what happens with revenue in the fourth quarter. We don't know that yet. But we have no reason to believe anything other than sort of flattish kind of expense at this point for the fourth quarter. And then in terms of the net interest income, I think we tried to make sure we were clear. We'd earlier in the year thought 15.5 to 15.7. We were making that projection a long time ago. That was a year ago. And now that we're 3 quarters through, and now that the third quarter was, probably a little ahead of where we hoped, we kind of feel like it's 15.6 or higher. It's going to be the higher end of the range is what we're trying to communicate.
Okay, and the capital markets backlog, how's that shaping up, and what does that look like for next quarter?
Well, in terms of the investment banking outlook, I talked about that earlier. The pipeline looks good. It's just a question of what we can execute in Q4, but it feels to us like this is a more constructive environment for investment banking than it was earlier in the year. And then in terms of the sales and trading business, obviously we have to think about the normal Q4 seasonality when you think about it relative to Q3. But it is I'd say it remains a very constructive environment for the sales and trading business in particular. So we feel good about that. We're off to a good start this quarter, but obviously it will depend on what happens with the markets overall. And then, just taking a big zoom out, always the key for us is just we got to manage those businesses for the long term. And we're looking forward to talking about that when we get together in November, together for Investor Day.
Sounds great. Thanks so much. Appreciate it.
We'll take our next question from Gerard Cassidy with RBC. Your line is open.
Hi, Alistair. Hi, Brian.
Hi there.
Alistair, you guys are talking about your consumer deposits, and when you look at your consumer deposits back in the fourth quarter of 2019 and compare it to today, obviously they're higher. And the Fed shows the entire industry's consumer deposits, household checking account deposits, are significantly higher from pre-pandemic. So that pandemic surge hasn't left the banking system. Do you guys have any color on what you're seeing from that behavior from pre-pandemic to today? I know you're taking market share and you're growing while yours are growing, but any color on why we still have such elevated levels of deposits?
Gerard, so I think if you remember back, and we're all in 21 and stuff trying to have the great debate about where all this cash that was put into the economy going to flow right back out, et cetera. And if you drew a line of the growth rate leading up to 19 over a long period of time and then saw a bubble above it, it was working. It's basically worked its way back down in the aggregate amount of deposits and relative synchronicity to the long-term growth rate. So the size economy is bigger, the notional economy is bigger. We can get economists in our company, and I'm sure in your company, that will have a great debate, notional, real economy sizes and stuff. But the economy is bigger, the amount of cash in circulation is bigger, so therefore you expect it. Now, the most important thing, though, is that we've gained share during that time in terms of core transactional. So we're 20%, 30% more core deposit transaction accounts in our consumer business. That's numbers of customers who are carrying, instead of $6,000, $7,000 an average, $9,000 an average. And at the same time, we've reduced the numbers of branches because of more digitization, automation, the numbers of teammates in consumer dedicated to service, et cetera. So it's a great operating leverage. So even though the economy grew and everything else, the fact of the matter is those deposits that are core in the all-in cost of all the consumer deposits, 58 basis points against the current rate environment, is a big profit improvement in that consumer business. And just in the last year, you saw a 30% increase. And it's still gaining the efficiency, not from cost reduction as much, but cost levels against the NII improvement. As the NII comes in the company, they are a big beneficiary of that amount. So I'd say I think you're now seeing deposits grow in the industry now at our company now for many quarters. I think it was the mid of almost 2 years, a year and a half to 2 years ago, where we bottomed out and have been growing since then. And so you ought to grow with the economic growth, and if you take share, you grow a little faster. That's the gig. But we don't see any dynamic that, even as they continue to adjust interest rates and stuff, that you see a lot of money flowing back out of the banking system. It's kind of already happened, frankly.
Got it. Okay. Thank you.
We'll move next to Saul Martinez with HSBC. Your line is open.
Hi, good morning. Thanks for taking my question. Obviously, you've had pretty impressive growth in commercial loans and markets lending up 36%. Just look at overall U.S. commercial loan growth well into the double digits. You obviously have a very good track record versus your peers in terms of credit.
Have you noticed the trend? They're only letting banks ask the questions. Of course, we know there's a lot of banks that do that, and that are the analysts. But this time, it's just banks after banks after banks asking questions. Last time around, we actually got something, and I'll share that with you. After this, I'll tell you about if I think XRP is still in a bull run, and what partnerships are actually there, but they're not telling us about. But stay with us. There seems to be a few more questions, but it's looking very strange this time. Last time, we got quite a few questions about AI, stablecoins, crypto, tokenization. We might still get another one or two, but the earnings call is a bit different to before.
Talking about here, typically the top asset managers or the top financial institutions in the world. So that's who we're interested in working with here. Beyond that, we're looking for collateral pools. We want high quality. We want diversified. We're looking for structures that have security, credit enhancement, performance triggers, mark to market. They typically tend to be shorter duration. And then, we don't put all our eggs in one basket. We're diversified across multiple sectors. So that can be mortgage, or it can be asset-based. It can be business lending or private equity. It can be consumer assets or subscription facilities. And when you add all that up, you end up with a diversified book that's typically investment grade. It's lower risk. And the loss content, if you look at our res crit, it's less than a basis point. If you look at our NCLs, it's less than 0.1%. So by the time you have those great clients, you have good collateral, you have good structures, generally speaking, you tend to have low losses. And then the asset test ultimately shows up in returns for the global markets business, because any losses they absorb. And over time, they've done a good job of deploying capital while increasing ROA and return on capital. So we feel like that business has worked well. Final thing I'll just say is, I feel like we have differentiated capability here in that we tend to have very strong relationships with these global markets clients that we talked about. We have the structuring and the underwriting, and we've got the excess in the form of lots of deposits and less loans, where we can actually make loans to those clients to satisfy the demand. Then it's just a question of, are we getting the return for the risk? We believe that we are.
Okay, that's helpful. I guess a related question, and I'd love to get your perspective on the sustainability of the results of your capital markets businesses. So not just the markets business, but investment banking as well. This quarter investment banking fees were at levels you haven't seen since 2021, and it feels like we really are in a sweet spot where we're seeing resurgent investment banking activity. A lot of optimism that this has legs, and this is also occurring in an environment where the markets businesses are performing well, not just for you guys, but for a lot of folks. And I'm just curious if an environment where we do see investment banking continuing to grow over a multi-year period, is that consistent? Is that an environment where the markets businesses can continue to stay at current levels in terms of revenues, because those are businesses that do generally benefit from more volatile economic and market backdrops. So I'm curious if you have a view on sort of the interplay between those two, and whether the markets businesses can continue to do well in an environment that is a little bit more stable, that is more suited to investment banking.
Stay tuned. There's only going to be a couple more questions. We might get it at the end. It's worth staying tuned, and then we've got the analysis at the end as well. So stay with me. Let's see if we get it in the last couple questions.
It's separately as a separate operating unit, because it supports the whole company, including the wealth management business, including the consumer business for FX transactions. So we disclose it separately, but to show its breadth in the company, but also to show it's less volatile than people assume it is when you're running the way that Jim and the team have run it. So 14 quarters in a row of year-over-year revenue growth is a pretty sustainable record. And there might be some day that's broken. It has been broken for 3+ years, so that's good. And the profitability, i.e. the returns of the business, continue to go up. And that has a lot to do with how they conduct the business and how they, it's a moving business, not a storage business. It's not holding a lot of risk on a given day. On the lending, it's high-quality assets underneath them, no subprime, et cetera, et cetera. So that's, so we feel that it's sustainable. And, yes, does it benefit, and especially on the equity side, when markets are moving around and people are trading more? Sure, you saw that this quarter. But overall, it just keeps grinding its way forward. Now, when you look on the investment banking, $2 billion in fees coming in the quarter. Everybody expected it to be less than that. It came. But you're seeing the activity spread out geographically. You're seeing a lot of activity in the mid-sized market in the U.S., which we are capturing through the combination of our investment banking teammates and our commercial banking teammates to cover all the markets and are out there in our middle market franchise and capturing strong market share from those customers. But I think one of the things you need to think about is that business. We run a global corporate investment banking business as a consolidated business, and that goes into global banking along with our middle market and our business banking business. Why that's important to think about is with our relationship with these customers, we have their credit relationship, their transaction services relationship, and the fees for that, I think, grew 12% year over year, and their investment banking, and their hedging and other types of things on top of that in the markets. And by doing all that, you actually have a more stable revenue stream attached to that business. So whether investment banking goes up or down by $100 million, if you look at the global banking results, the volume of revenue is coming from the lending side and the deposit side. So, it's great to see Matthew and the team have a good quarter, but Matthew themselves would tell you it's also great that the loans grew, the deposits grew year over year, the loans are solid, and then working with the middle market and the loan growth we're seeing there, it's a holistic view of the customer, and I think that's sustainable.
Great, that's very helpful. Thank you.
And it does appear that there are no further questions at this time. I would now like to return the call to Brian.
Okay, let's give you the analysis.
Thank you, operator.
They're not going to say anything else. Okay, so that was very strange. No questions other than from the major banks. That didn't happen last time. Let me just show you this clip from last earnings. We covered this last earnings, and for everyone who says nothing happens and it's not important, well, let me just show you this clip from last time we covered their earnings.
Great, Brian. And then as a follow-up, just a broader question for you. Obviously, there's been
Let me turn up the volume. There you go.
I want to talk about stablecoins. Can you give us your view of where you see the adoption of stablecoins going forward and what that might have in terms of impact on payments revenues or deposit?
This is important. They said this last time. They did actually give us a couple hints this time round about AI. I'll be telling you that as well, and then I'll give you my analysis on the markets and XRP as well. So just stay with me. Listen to this from last earnings.
Trends for Bank of America and possibly the industry.
Yeah. So focusing on stablecoins as a transactional device, if it's a new payment rail and we have trillions of dollars we move for our clients every day, we believe that if they want to use stablecoins to move part of that money, they'll move. So consider them having an account, and they can send out money in U.S. dollars. They can also initiate transactions, have it go into euros, and it could have it go into stablecoins and then transact in that system. So we feel both the industry and ourselves will have responses. We've done a lot of work. We're still trying to figure out how big or small it is because of some of the places are not big amounts of money movement. So you'd expect us all to move. You expect our company to move on that. In the end of the day, the debate will be how big an item this will be and how much more an effective payment stream it is. And there's places like small balance transfers across border that you can see the case. You can see it with sort of smart contracts and money movement. You can see it in digital native apps, in-app payments and stuff. But we'll be there just like we were there when we moved from checks to Zelle, and you can see that when the industry puts its mind to it, if you were talking to me 6 or 7, maybe 10 years, you'd say, this thing called Venmo's coming on, and you guys can be left behind. And here we are. Our Zelle payments exceed Venmo's total volumes today, and the industries are multiples. It's just because we can move money efficiently, and we have to be aware of the attack on the payment system, and we'll be there to defend it.
That was massive what they said last time. They were talking about how important it is to start digitizing using stable coins and keeping up and making their systems more efficient. So that was picked up by a lot of accounts last time around. We got 300 likes, 200 reposts because it was major information and everyone was asleep. That's why we cover these earnings calls. The crypto market went up on that information. So Bank of America CEO Brian was asked about stablecoin adoption and the future of payments. His response was clear. We believe clients will want to move funds using stablecoins and will support that. They are most likely going to be using something like RLUSD, in my opinion. But then he said, we'll partner with some of the stablecoin providers. We already have partnerships with some of them. Who do they already have a partnership with? They already have a partnership with Ripple. We know they already have a partnership with Ripple. This time round, they were very careful not to speak about anything like this. They handpicked those questions and they didn't want to talk about this any further. Bank of America has long been linked to Ripple, featured in Ripple's official partners list, involved in RippleNet's pilot programs, participated in ISO 20022 testing alongside Ripple, mentioned in SEC filings tied to Ripple consultations. He also said smart balance transfers across border smart contracts, in-app payments. These are exactly the use cases for Ripple and what the XRPL was built for. Bank of America knows the game is changing and fast. So it's important to be watching these earnings calls. The reason why this X post is very well, I've got a very small following on X. Do go and follow my X. But we got incredible views and likes on this post. Why? Because every other XRP account that pretends they know what they're talking about, every other crypto account was not doing the hard work and was not listening to the earnings call. There was a lot of idiots in the chat today saying, why are you covering the earnings call? They're never going to say anything. Well, yes, the likelihood that they announce something is low, but if they do, that's great. More importantly is if we start understanding the bank's business, which way they're moving. Are they using AI? Are they talking about transactions? Are they talking about efficiencies? All of these things that we can look out for in earnings call will be ahead of the curve, and we can understand our investments a bit more. Not just buy a token because you think it's great and you don't know all the information. You need to understand what problems XRP is forming, and you do that by looking at the earnings call. So a lot of idiots in the chat today saying, this is stupid. Why are you watching this? Earnings calls aren't important. Well, they are. Look at what happened last time. Everyone was asleep behind the wheel. We were doing the real hard work and watching these earnings calls. Yes, they're boring, but investing is supposed to be boring. It's not just read some fake title on X and just go buy out and buy a coin. That's not how it works. So I just wanted to show you that in last earnings call, only a few months ago, we got a lot more better information. This time we didn't, but let me just tell you some facts as well while we're talking about this. Firstly, I want to show you this video from a CEO of Sound Planning, David. He said this about Bank of America.
Thanks.
Another one you like is Ripple. You said it is the coin to be looking at right now.
Absolutely.
Why?
Okay, so Ripple actually was the second largest coin prior to the SEC's investigation of them. They did this really weird lawsuit against them, and basically the Ripple's going to be the track that everything's going to be running on in the future. So they created their own stable coin right now.
Okay.
And Bank of America, like I said, they were doing 100% of their internal transactions. They've got 83 different patents on it, and there's some incredible stuff that's going to be coming out.
There you go. That is someone talking about how Bank of America's internal transactions are running on XRP and they've got all those patterns. It's not just me making things up. We do the research. Let me go to today's newsletter. Again, more research. People don't like to do research. And let me tell you a bit more about some things related to Ripple and Bank of America. So they do have a relationship. Bank of America has maintained a structured relationship with Ripple for nearly a decade. The bank joined Ripple's Global Payment Steering Group in 2016. They've got a long-lasting relationship here and participated in early pilot programs aimed at testing interoperability with existing SWIFT infrastructure. Remember, Ripple is trying to make moving money more efficient, and they will work with banks. That's primarily what they're looking for. Again, now they're branching out tokenizations, DeFi, real estate, all of that sort of stuff. But their core business is still helping banks. So in 2020, BAI Banking Strategies podcast, this was during a podcast in 2020, the Bank of America's then head of global banking, Julie Harris, confirmed that the bank has integrated Ripple's technology within its payment architecture. This is someone from the Bank of America saying this. This is showing that these partnerships are real, and we're just waiting for the official announcement of how they're using them, and an official press conference around this, or being mentioned in an earnings call. So she confirmed that the bank has already integrated Ripple's technology with its payment architecture, describing it as part of the institutional client connectivity toolkit. Furthermore, the bank has filed more than 80 blockchain-related patents, including several describing real-time distributed ledger settlement systems that closely mirror RippleNet's design. Although there's no public disclosures confirming live XRP usage, Bank of America repeated pilot involvement and participation in Ripple's standard group, suggesting active evaluation of technology scalability within regulated frameworks. Now, the question some people pose, are they just going to create their own XRP? Are they just going to use their own stablecoin? Well, let me try and educate a bit further. So, with large banks, while large banks could theoretically issue proprietary tokens or stablecoins, such approaches are operationally inefficient and regulatory constrained. For a globally systematic important bank, GSIB, like Bank of America, a self-issued token will be classified as a deposit liability, subject to Basel III endgame capital and liquidity requirements. This treatment would require daily reconciliation against insured deposits and would eliminate most of the capital efficiency gained from tokenization. It would make them actually more inefficient if they did it themselves because of the global rules around it. So a Bank of America coin, or whatever you want to call it, would also face severe liquidity and interoperability limitations. It would function only within Bank of America's internal network, offering no external liquidity or settlement capability with other coins. Cross-bank transactions would still require conversion, replicating the same bottlenecks that tokenization seems to eliminate. In contrast, assets such as XRP and RLUSD operate as neutral shared network instruments. This is open source. Anyone can use it. It's interoperable. That's the point of it. They are designed to move across institutions, providing instant settlement without fragmenting liquidity or creating siloed systems. It's not going to work if every bank has their own token and they're trying to transfer it to each other and then they have to change it to this, to that. It takes away all the efficiency from the blockchain if everyone wants to create their own token and stablecoin and try and work together. So technically it's possible, but it just doesn't make any sense. And it would require a lot of research and development from these banks. Anyway, let's continue. Technically, interoperability is another barrier. Maintaining proprietary blockchain infrastructure would create a vendor lock-in, increase cybersecurity exposure, and raise integration costs for counterparties. Shared ledger models like Finality, which Bank of America already invests in, are explicitly designed to solve this by enabling bank-to-bank settlement using standardized regulated rails. Finally, issuing a standalone stablecoin would require extensive regulatory engagement, new capital buffers, and dedicated compliance infrastructure. From a cost-benefit perspective, leveraging established networks such as RippleNet or Finality provides faster deployment, deeper liquidity access, and alignment with evolving supervisory standards. For these reasons, Bank of America's most viable strategy, they can do it, but it's not the most viable strategy. It would be sort of shooting themselves in the back, in the foot. Bank of America's most viable strategy is participation in interoperable regulated settlement ecosystems rather than developing a closed proprietary token. Let's talk about the landscape as well, because Larry Fink came out with the bank with BlackRock earnings yesterday and as a beat. So I want to show you this clip as well. So the SEC's June 2025 settlement with Ripple formally ended all enforcement actions and provided institutional clarity for XRP's use in the United States. The decision eliminated the final legal barrier preventing banks from adopting XRP on related on-chain settlement tools. Remember, I told you at the time, it's going to be sort of a nothing burger now. The part that XRP is going to pump on the day and it's going to get sold off once all the court case came to an end and everyone dropped their appeals. It's going to pump on the day, but when it's going to start getting important is 6 months, 12 months, 18 months down the line, because that's when people can start working with XRP and work with Ripple to integrate it. It's not about the day that the case is dropped. It's about how now they can actually start working with banks. So we're coming up to the time where behind the scenes, I'm sure a lot of conversations are going on. So in parallel, US regulators have advanced frameworks for tokenized deposits and fiat-backed stablecoins, defining the requirement for capital treatment, redemption, and audibility under existing banking law. The clarity allows banks to conduct tokenized pilots under full prudential supervision. Globally, institutional adoption continues to accelerate. BlackRock's BUIDL fund has demonstrated real-world tokenization of money market fund shares. Goldman Sachs and BNY Mellon have completed tokenized collateral transfers within regulated environments. The UK Financial Conduct Authority and the Monetary Authority of Singapore have both approved tokenized fund registers and interbank settlement models. This is from Larry Fink yesterday on CNBC.
What do you mean by digital? I do believe we're just at the beginning of the tokenization of all assets, from real estate to equities to bonds across the board. It's very loud here. It's very loud, but it's good. Capital's at work, right? You like that? I love capital at work. Yeah. There's $4.1 trillion of money in city globally in digital wallets. A lot of that money is outside the United States. If we could tokenize a ETF, and digitize that ETF, we could have investors who are just beginning to, invest in markets through, let's say, crypto. They're investing in it, but now we could get them into the more traditional long-term retirement products. So we look at that as the next wave of opportunity for BlackRock over the next tens of years, as we start focusing, moving away from traditional financial assets by repotting them in a digital manner, and then having people stay in that digital ecosystem. They can have their cash, and we have the largest cash money market fund that's tokenized called BITL. Our Bitcoin IBIT is now over $100 billion. I know from nothing not that long ago. Around 2 years ago, zero. Yeah, I know. Well, you more know it's a huge proponent of crypto, as we know. Yep, love it. But I grow and learn. I heard you say that on 60 Minutes. I did. Yeah. Jim?
There you go. A lot from Larry Fink yesterday. Nothing like this from Bank of America. Talking about tokenization, talking about integrating crypto, talking about how he was against crypto and now he's for it. He's grown and learnt, and a lot of these banks are growing and learning. They will be left behind if they do not. This is all taken from our very own newsletter. So if you haven't got the newsletter yet, remember every single morning you get all the real information, what's actually going on in the markets. You get the top stories at a glance. You can see what's going on. Trump's threatens trade retaliation, Waymo's, robotaxis, tokenization funds. US regulators embrace tokenization funds. That's today, and we've already got the story on it. We've got Musk playing 56 billion every single day. The top stories, you can see them at a glance. Then you can see the market snapshot, what's going on in the markets, the money move of the day, the top story of the day, the 5 things you need to know every single day, the deep dive of the day. You get the charts of the day. You get the on the radar, what's going on market-wise every single day. So you get this every day. You can even just click on it and read the top stories. If you want to engage a bit more in any of those stories, you can look into it in the newsletter. I think it's the best newsletter on the market. I spend 3-4 hours every single morning putting it together. It takes 1 second to subscribe. It's about 33 cents a day if you go for the annual plan. There is a 1-week free trial. I'll put the link in the live chat. It's the first link in the description as well. Or there is a free plan where you can see all those glance of the day in the first part of the newsletter every day as well. So do consider subscribing to the newsletter. Let me talk to you a bit more about Bank of America, XRP. I'll show you the chart, and then we're going over to our second earnings of the day. So let me wrap this up as well. So just if anyone's interested in Bank of America themselves, again, they are up about 5% this morning, 4% now. We are looking at Bank of America potentially hitting the highest price since their all-time highs back in 2007. Yeah. But before the banking crisis, 2007, we're approaching those levels once again about 20 years later, or 17 years later. We are approaching those, how many years? Yeah, 17, 18 years later. We're approaching $55 again, and if we do breakout, we've got our targets of $65 short term, and then potentially $87 if we don't go into a recession before we reach those levels. So Bank of America, we are looking at an all-time high breakout on Bank of America, but if you're looking at what banks are targeting, the sort of consensus is about $57 on Bank of America. That would be breaking out of all-time highs. So the market and the analysts are predicting that Bank of America does go higher. We've looked at the earnings as well, so I don't want to go into that too much. And again, remember, ISO has just gone live a few months ago, so they are going to be looking to integrate. Well, they have to be using that now, but they're looking at what cryptos are ISO compliant or what crypto systems are ISO compliant. And remember, the XRP ledger is. So I'm sure that behind the scenes, there's talks going on. It's always important to cover these earnings because that's when we will start understanding what's going on behind the scenes. We did get a few quotes today from the earnings that I want to bring out to you. It was actually only one of the first questions only that gave us an insight. Remember, this time round, they are trying to keep it close to their chest. They didn't want anyone other than banks asking the questions, and obviously the banks won't be asking about that because they're going through the same thing. So one person did ask about AI systems. They said, the quote was, there are many applications of AI going on in this company. This isn't something to come. It's been here for a while. This is Bank of America saying this. So Bank of America is saying AI is already fully deployed. It's not in testing. It's the same slow and steady rollout model they've been using for new financial technologies like digital payments or blockchain pilots. That's what they're saying. They're basically saying, slow, steady, we're bringing out these new systems. This is from today's earnings call. The quote from Bank of America was, there are many other applications of AI going on in this company. To me, you have to read between the lines here. There's many other applications of AI going on in this company. I think they're literally saying there are ways we are making ourselves more efficient through AI, through different applications. I think they're talking about blockchain, tokenization, and payments. They've said this isn't something to come. We've been at it a while. And if you look at those partnerships with XRP, with Ripple and Bank of America, it's been there for a long while. What else they said? Well, they also said we had 213,000 people now versus 285,000 15 years ago. Volume's gone up huge since that time. So they're saying, obviously, now with the AI, automation, efficiencies and cutting costs, they are still boosting throughput, proving Bank of America can still scale tech safely. So again, that's the same framework that they will be applying to tokenization or on-chain systems. They also, another quote would be from Bank of America, to put it in place, you have to have data appropriately rated and models giving the right answer in a controlled environment. So I think that's talking about sort of the process needs to be tightly governed. This mirrors how on-chain payment systems would need to operate. They need strict regulatory control. Remember that we are going for a deregulation situation now in the US, so we are thinking that it will be easier for them to put systems like this in place. What else? I'm just going through my notes of what else they said. Let me just, that just turned off. Yeah, there also talks about, what was it? Over the last 24 hours, there was 2 million interactions where customers got an answer from Erica. So if you don't know what Erica was, I think Erica's their AI assistant. So Bank of America's AI assistant is handling millions of real transactions daily. So that they were trying to prove there that the question was about AI and integration. Are you doing it? That why are you slow to it? When is it going to come? They were saying, look, literally in the last 24 hours, there was 2 million interactions with our AI system. It's showing proof that the bank deploys these technologies and it ramps up to scale, but only after it's production ready and it's compliant. But the final thing that was quite interesting, they said we'll have experts talk to you in early November. So next month, during Bank of America's Investor Day, we might be covering that as well. So I'll keep an eye out for that, because that's when they're probably going to talk about their large scale tech, AI infrastructure, and potentially digital asset strategies. So early November, I don't know if any of you caught that. That's what they said. Let me go to your comments. That's what they said about talking more about AI and their next strategy meeting. So we will be covering that. That's maybe why they didn't take any questions about crypto, blockchain, tokenized assets today, because they want to announce it in November. They don't want to front run that. Oh, Jose, thank you so much for the $1.99 super chat. That really does help. Thank you for the super chat. Human Being says 430 watching. Let's like more. Yeah, if you do appreciate us doing the hard work and covering this and trying to get more knowledgeable and sharing that with you, it's free. Just hit the like button, subscribe if you haven't done so already. I know there's a lot of trolls that think we're stupid for covering the earnings calls, but at the end of the day, this is where we get the information. And other people are too lazy to cover it. Yes, it's boring. I don't think it's the most interesting thing listening to all those numbers. However, you have to listen to it. You have to at least have it playing so you can see if anything is said and what they're saying underlying. So there we go. That's why we cover it. And of course, some are requested to cover it. So of course, we're going to cover it. So CEO of Bank of America will be on CNBC in a bit. Thank you, Jose, for that. Sorry for my typos. Look Chinese. No worries, human being. Thanks for the letter. No worries. The CEO of Bank of America will be on CNBC. If you do appreciate it, let me just go over to members only mode. And we're going over to our next earnings. Let me just check when that's starting. Let me just move that back slightly. We'll start that at the half hour. I need to have a drink, and then I need to end the show. And then we'll go over to our next earnings about NVIDIA. Oh, it's actually ASML earnings will be next. We're covering that in about 15 minutes time, so stay tuned for that. This video will take you directly there. Again, a big semiconductor company that will give us some insights. So let me just do what was I going to do? I forgot what I was going to do. I forgot what I was going to do on the system. Anyway, it doesn't really matter. What was I going to do? It doesn't matter. I was going to go members only mode so I can answer all members' questions. Subscribers, you can obviously still stay here. It's just members only chat for now. If anyone does want to become a member and participate in that and ask any questions and support the channel, here is the membership link. Take 1 second to become a member, and you can ask your questions. I'm just going into members only mode now. So let me go here. Members. If you also do a super chat, your comment will be heard as pop up live on the screen if you do want to support the show. Deja says, good morning. Hello. All members can now ask their questions. We'll do a quick members Q&A. And then we'll come on to our next earnings. All subscribers can stay tuned because we're going to a next, or viewers, we're going over to our next earnings in the next 5-10 minutes. We'll have a look at the markets as well. We'll look at XRP's price as well. So stay with us while we get set up for our next event. Was there any other members' questions that I've missed? You can't say you can say XRP is a bridge ETC, but without retail, it's worthless. Lawsuit dropped only $3.60. Remember, yeah, I said that's very important. It's because you have to wait. Remember, when we talked about XRP, I mean, I don't know how many times I can say it. We've literally called everything spot on. I mean, the day of this big liquidation event, the day Martyn's like a 4 days ago, was warning and saying that it's going to crash, and XRP did crash. The morning of the crash, before we had any indication we were going to crash in the markets, of course, we had our own indicators. We put out 4 reasons why the market is going to crash. And let's just go back to and just look at every single event. In the bear market, at 30 cents, we were buying XRP live on the show. The SEC case was dropped and we pumped to about $1. We were expecting to maybe go further, but we learned a lesson. What was that lesson? Well, the market doesn't actually care about the lawsuit that much. It's short term, it doesn't matter. It was the biggest event ever for XRP, the token, and the longevity. If they lost the lawsuit, we would have gone to zero. But yes, this is where Judge Torres, this is back in July of 2023, Judge Torres ruled that XRP within itself is not a security. The price pumped 150%. A month later, it dropped 50%. That was a lesson we learned there, that if there's any other further positive updates in this case, if they win their appeals, everything like that, it doesn't matter because we can come straight back down. So we were still buying it. We bought on the dip. We didn't buy the pump. And then in November, we looked at Bitcoin dominance. Bitcoin dominance was falling off a cliff. And then we said, okay, this is time to get into altcoins. And then we bought, back in November of 2024, we bought altcoins. We bought XRP. XRP's price was at 55 cents. We went to all-time highs. We predicted that big run up. Then we said we're going to come back down to $2 and have a 50% crash. We did. Then we said we're going to break out to all-time highs. Then we did. We went to $3.40. Then we said, if we don't break out $3.40, this could be the run up that takes us to $10. But if we don't get back about $3.40, we're going to have another correction, go back down to $2. And we said, what did we say? We said, what was that month? I forgot now. Was it September? No, not trying to remember the months now. It was February. We said we're going to go in a down month. Anyway, we said we're going to go down. And even if the appeal gets dropped from the SEC, we're going to have a pump on the day, but then continue the downtrend. And that was because of the lesson we learned earlier. And that's exactly what happened. We had a 36% pump on the appeal being dropped and the case officially being put to bed. And then the next, what followed that was a crash down to $1.50 in time. So we were expecting that to bring us down it brought us back down to $1.80. We went on our final run up where we said we can go to $10, but we didn't hold $3.40, and then we went into downtrend. So what am I saying now? Well, now it gets a bit difficult. Are we already in a bear market or are we not? Well, I think there's a 50-50 at this point, but because of what will actually happen in an altcoin season, I think XRP can go to $10. I think altcoin can go up 500%. I'm willing to stay invested for the chance that we are still in a bull market. I still am edging on the side that we are in a bull market and we're entering the euphoric period towards the end over the next few months. But I am also aware that we can go into a crash, go into a recession potentially, and then pump into a final altcoin season. What I want to see is Bitcoin stay above 100,000. If Bitcoin stays above 100,000, I think we're fine. I want to see momentum come back into altcoins over the next few weeks. I want XRP to put in a higher high. And then I'll be confident again we're going into bull market. But either way, I've always said be prepared for all situations. Be prepared for the upside, which is $5, $10, $20. Be prepared for sideways action, which is going between $3.40 and $2, which is what's happening now and what we've been prepared for. And be prepared for a bear market, which is an 80% crash. Bitcoin, XRP going back down below $1. All of those scenarios, if you are prepared for them, then you can sell when it goes up, then you can accumulate when it's going sideways, and then you can buy when it's in a bear market. If you're prepared for all those situations, you will come out on top. If you're leverage trading, if you're panic buying, panic selling, FOMOing, that's when you lose out. I think XRP is going to be a great investment long term, but I don't give financial advice, so please do not buy or sell based on anything I say. We do have a new great membership as well. It's the Electrum memberships. It's what we host every Sunday night, and we're going to do some streams throughout the week as well, potentially, where we do trivia and we answer all your questions. It's a small group of us. It's a membership above silver, so you get all of the bronze membership perks, all of the silver membership perks, and then all the Electrum membership perks. We answer all your questions, do the chart requests. So do consider becoming an Electrum member. It is our newest membership, and I think it's our best, most cost-effective membership because a lot of it's at our cost. So do consider becoming an Electrum member or upgrading to Electrum membership because we had a lot of fun on Sunday as well. We did a lot of chart requests, and then we had our winners here as well. 11 of you got this right. We give away prizes and all sorts. Here we go. Drum roll, please. Electrum Podium Week 2, number 3. Rene Zanin. Rene is on the podium. Number 2 is loaded, which means number 1. Is it Christopher? Or did he get it wrong? It is Christopher Pennington. He is number... That was great fun. We had all of the questions throughout it as well, going through the chart. Let me go over here. After the crash, from 4.2 to 2.5 to 3.7 to 4.5 or 3.3 trillion. Here we go. 2 seconds. Oh, loaded. You're there. Sorry. I keep choosing the same clip. Anyway, that was our Sunday event. We had some great fun. What we're going to do now is go over to our next earnings. This will take you directly there. If you don't have the link yet, let me give you the link in the live chat. We're going to ASML. Please do join me there as well. This will be another earnings call for us to go through. Here is the link. There is where we're going next. I'll be live in 15 minutes. Oh, we've got a few members join us. Oh, welcome to all the new members. RC, welcome to Bronze again. Check out MARA RC. Let's have a look at that. Lynn Zanston, welcome to Bronze. Thank you for becoming a member. If anyone else wants to become a member, you can become a member using this, and I'll answer your questions now as well, because we're in a members only chat for now. But we just got a chart request. What was it? Mara. Is that Mara Holdings? Let's have a look. It's a RC. It's a stock, right? Mara Holdings. It's a stock, but it's involved in crypto. Oh yeah, here we go. Yeah, it's very simple. We've looked at this recently. Uptrend has been consistent. We're now above $20, which is the level to get above. So right now the chart is suggesting we are going up to about $30. If you want to be safer and you want to take profits earlier, then you can look at a Fibonacci retracement and look at the 786. So that'd be around $25, which will be the same as this height here, which is what I was looking for. So yeah, the next targets for this are $25 and then $30. And then you can see if you get back above that, we can look at 55. But for now, the support's at $20. The next target's at $25, the safer target, and the main target is around $30 RC. There we go. That was a quick one. Thanks for your request. Okay, let's go over to our next earnings. Stay with me. We are going to be covering, where is it? It's over here. The investor call is available. The recording. Let me just make sure we are live with that. Yeah, we've got it here. So I will be live with the ASML earnings call. Don't know what's going on. Yeah, we'll have that prepared for you. So thank you everyone for tuning in. Again, we are live every single morning. Do consider subscribing to the newsletter. First link in the description. You get all the news directly to your inbox. Let me just check this. Make sure we are all... Oh, I think we've got Martyn calling in. Let me just open up the interview screen. Here we go. I think we've got Martyn calling in. Let me just make sure that we are set up for Martyn to call in. 1 second. I think we've got Martyn calling in. There we go. That's all fine. Martyn, welcome to the show. Oh, are we back to live?
Hi.
Are you on?
How you
Here
doing? You all right?
Yeah, I'm doing well. Thanks for calling in. We can hear you.
Great. Lovely to see you this morning, Sensei. Great show. Thank you very much for covering it. I just wanted to say that the numbers from Bank of America and other banks, it's not just the Bank of America, but other banks are reporting today, and the market is rallying on this expected earnings season to be up. So we do expect earnings season to be up. The S&P is rallying 1.13, expecting 1.5% by the end of the day, which is a huge rally on the S&P. I'm currently out of the S&P in T-bills, earning 4.5% a year. I think it's important to protect your money at the moment. I'm 100% certain we're going to get a bubble burst. This is great that the earnings has beaten. It gives you the opportunity to look for an entry point to get back in, but I certainly would not be chasing this today. I think people are going to buy, to pump, to dump, take profit, and then the real investment comes in. But it's great to see that earnings and banks doing well today. But we do want to wait for an entry. A lot of FOMO is kicking in. People are buying this, pumping this up. But I am really confident that we're going to get a 20% pullback on the S&P, which would be a 50% to 80% on crypto. So I think today is a perfect example about patience, just waiting patiently for the right time. It's obviously, these banks are performing well. I think other earnings are going to do well equally. But that just gives us more confidence to buy those businesses when they become fair value. Everything is now hyper extended. We want to wait a little bit. But anyway, thanks Sensei for doing this show. I know you're going to cover ASML. It's a shame that we didn't hear from Bank of America today talking about crypto and
what do you think about everyone in the chat saying it's silly to cover these earnings when nothing's ever going to happen?
Yeah, well, it doesn't surprise me. It's not coming from our members, was it? It wasn't. It's never coming from not coming from the Lucas. It's not coming from the informed investors. It's coming from idiots. I'm just going to say as it is, idiots that are just gambling and thinking it's boring. It was great. I was listening, taking notes like you were, very intently to what was being said. Even though I'm on my vacation, I'm listening to all these earnings. ASML will be a great one, looking at that sector as well. But we get to hear about how the institutions and banks are performing, so we can understand and value the market, and we can buy an informed market. There's no point just guessing. We're not here to guess. I mean, I shared on my X. You might like to share this if you can while I'm talking to you. On my X this morning, I showed my latest trade. This is really important. Click on this. If you click on the second picture, not the beware, I think that kind of speaks for itself. But if you click on the second picture, this is the S&P over the last 1 month, and you can see it's up 0.85. If you now go to my portfolio, and there's no margin, so it's not amplified, up 1.16. Nearly double the S&P over the same period. If you now show the all time the year, I'm up 28% on the year. And if you go from that bottom of that V-shaped dip, I'm up some sort of 50% on the S&P. There's no margin. This is an amplified numbers, right? I had margin, but there's no margin now. There hasn't been for a few weeks. So, what I'm trying to stress there is you can make money reliably, efficiently, and consistently, and that outperforms anything. If you can do that over and over again and stop losing. So now my money is all sat 300 grand sat in T-bills, earning 4.5%, safe, secure, no issue whatsoever, and I can sit there for a year. Is there 4.5% in the S&P this year? No way. Not a chance. And if there is 4.5%, the bubble's going to be even bigger. So all I've got to do is wait, and that's the hard part. And investors and gamblers, non-members who are watching the show, don't understand that. They're looking at the market and they just want everything to go up in 5 minutes. And they're not. And I don't find. I know you even said yourself these numbers are boring. They're not for me. Because I'm really learning about where the businesses are going next. So it gives me greater and greater confidence to buy, and I'll buy big. I mean, I've done it the last 4 or 5 days. I've traded 20 times plus, I don't know, in and out. Because at the moment, it's a time just to buy the S&P very quickly and make a percent on the dip. But because the business is doing well, you can buy it knowing it's going to go up a bit more, but get out again because it's overbought. And you don't mind owning the S&P long term, because if it does dip 20% and I happen to be in it and I've traded it 20 times and I've made 1,000, 2,000, 3,000 each time I've done it, doesn't really matter if it dips again. I just have to wait. I get, I missed that last trade. But at the end of the day, the earnings is what tells us about the strength of the businesses that we're buying. So it's important, it's not boring. This is how investors invest. And everything about great American businesses is great. There's nothing wrong with the businesses. It's the price we're paying for the shares. we're paying the future value, and we're paying 5-10 years in advance. And that's the problem. And that's it. It's because everyone's excited about owning great businesses. We all want to own Nvidia. We all want to own the future of everything. However, if you pay too much, eventually it pops, eventually everybody sells, and now you spend the next 10 years waiting to play catch up. So you can't just buy and hold. You have to be trading right now, which is what I'm doing, sort of making money all the time. That's how I'm beating the market. And I'm just waiting for a bigger crash. Now, when we get our 20%, I can buy and then leave it. And I won't have to trade it anymore. I can just leave it. But right now, I thought the Bank of America earnings was good. It was disappointing. They didn't say anything about...
They're rallying now. 5% Bank of America now is up.
Yeah, I'm not surprised. I'm not surprised. They're going to make more money. Remember, I said the number one industry is the finance sector. So if you like money, if you like crypto, if you're excited about crypto, own the bank, own the very thing that uses it. So like I said before, do you want to be a man digging in the dirt, panning for gold, or do you want to be the man that owns the factory that built the shovels, which now, years later, became Macy's? You know, a great institution of America. Well, I want to be that person. So I want to own the banks. The banks are going to make more money. They're going to be more efficient. They might not have shared it today about crypto or which and whatever. But at the end of the day, that's the business to be in. So I'm not surprised the bank is doing great. But there'll be a sell-off. There'll be a reposition. We still don't know what's happening with China. Just because rates are going to come down, which they will, the economy isn't all perfect. Jobs are slowing down. There'll be an opportunity to buy. There's always a better time to buy. No matter when you buy, you've said this time and time again. There'll always be another time to buy again at a better price. So yeah, great. I'm going to listen intently to your ASML earnings. I think everybody should tune in. I highly recommend as well, everyone. I learned a lot, actually. I didn't think you would catch me out so much as you did. But your Sunday night Electrum show was fantastic. I think I was in first and second place if I played along. So I'd done pretty well. But there was quite a few things I didn't know. And your Electrum events are great. They're fun and engaging for everyone, but they're educational. And you can play along in a game show style thing. Everyone, loves a game and has some fun. And you give away prizes like chart requests, and I think you do some merchandise as well. But the chart requests are very valuable, and you can win those for free by attending an event which you're learning how to invest and trade. So if anyone, whoever's listening now, every Sunday, Sensei does this Electrum show. Strongly recommend that you become an Electrum member. This is the game show here. It's like a TV show. And you can basically upgrade from silver or bronze to become an Electrum member. So I think you're paying a couple of bucks more than silver. And that's all you're paying a month. And then you can take part in this interactive private event and learn stuff, and it's great. I mean, what's amazing about that is so many investors who call themselves investors don't know some of the really basic stuff. It amazes me, and you really need to. I mean, how can you invest if you don't know the basic stuff? So that quiz, that game show is great. I'm really glad it's growing well. I think
it's great
48. Fun. Yeah. I think you had 40 odd people the first week, Electrum members, and now I think we have like nearly 60 Electrum members. So if anyone is a bronze or silver member, consider upgrading to Electrum. Sensei will give you the link. You can always downgrade back to your silver or bronze again. And everybody who's gold and upwards, I know we've got a lot of gold members and sponsor members, you now get this included in your membership for free. Because anyone above Electrum, this is now an additional benefit for you for free. You weren't paying for before. So everyone should be an Electrum member, at least, give it a go anyway. So yeah, good luck on that. So I'll let you get back to it. All good news today. Love it. Banks are looking great. Banks are the reason we own crypto, if we own crypto at all. I mean, if you own crypto, it's because of banks, isn't it? Otherwise, what are you owning it for? And they're doing well. They're more efficient. Would have been good to have heard, it mentioned.
They did mention an event early November where they might have been holding off, because you've been on earnings calls yourself and they have to verify these questions beforehand. So maybe they didn't accept any crypto tokenization stablecoin questions because maybe they have
Yeah,
to, they're doing an event in
yeah.
early November to announce it.
I noticed they didn't take any questions on crypto at all, and they've got something coming up in November. Having been on, I think, 3 earning calls myself, not just cover them like you did today, but on them. When I did them, I had to have my questions approved by the company and SEC regulated. So they're not going to allow questions for things that are about to come out and they can't talk about it. And I've experienced that firsthand. So that could be an indicator of what's coming in November. I know everybody's like, oh, waiting again, but this is a waiting game. It's just, this strategy is about timing and waiting. So I think some good news is coming. We just have to wait for it. But clearly, the bank is making more money. Clearly, the bank is a bit more efficient. There's something going on behind the scenes, just because they haven't told us about it directly. It's really exciting. So continue that great work, Sensei, and covering the earnings. Just because people in the chat who are not the members don't understand why we do it, that doesn't bother me. We're here for investors, not clowns larking about. And I watch your show for my own investment strategy as well. I'm watching you, so I can make money myself. So it's great. ASML will be fantastic in a minute. I know you're covering that one as well live. So anyway, everybody stay with Sensei for that, and consider your Electrum membership. I think it'd be really worthwhile to learn more about what the markets are doing. But yeah, just to reiterate, then I'm really happy with the market today. Really great, but I'm still sat out. I'm waiting if we can get a dip today on the news of what we had today. I will buy that. I will take a 0.5%, 1% profit and get out again, because as well the market is so overbought. I don't want to be permanently sitting around. I just want to be in and out, making 3 or 4 grand a time, and parking my money in T-bills. And when the time to return and live back in the S&P, then I'll come back. But it isn't right now. It's an opportunity to just keep trimming that. What's your thoughts on that strategy, Sensei?
No, I think it's right. I mean, I've said that the bubble might continue a little bit. I mean, it might go up 3, 4, 5 more %. But if that happens, then the bubble's bigger, right? And it can pop. So it does give that opportunity at the moment to make those trades, but being prepared for what is looking like it's an inevitable. I mean, we saw what it could look like on Friday with crypto and that massive liquidation. And you've been talking about for the longest time about that crash that could happen over the last week or so, and that did happen. Stocks went down as well, 3.5%, but I think there is the stock market can go down a lot further as well. We'll see what earnings season holds. If earnings really beat, then maybe we get another 5-10%, maybe not 10%, maybe another 5%. But then after that, if I'd expect to really come down, because even if earnings beat, we are still expecting a 20% correction on the S&P 500 to come back to fair value. If we want to go below fair value, then which we normally oscillate between overvalued and undervalued, then that's like 30% drop. So that's the numbers anyway.
Yeah, I mean, you got it spot on. People make the mistake thinking if we've got an earnings beat, then I should be in. An earnings beat and forward guidance tells you that you can look for an entry point on this business. You want to own this business, and if you buy this business today and it's good and it's performing well, in 5 years you're more likely to be up. So then why not buy it? A long-term investor, fine, go ahead and buy it. However, if you want to maximize your benefit, there's no point just sitting around when everything is already overbought, predicting those future prices. I mean, I've just given you you've just shown on the screen my actual performance without margin has outperformed the market without any risk. I mean, it's a wonderful feeling. I'm sitting here today with $300,000 earning 4.5%. I'm lending it to the government. The stock I use is SGOV, which is T-bills, right? I'm lending the government money at 4.5% with no risk at all, unless United States go bankrupt, right? And I don't have to be in the market. I can just earn that money, and every day I just dip in, make another couple of $1,000, sit on the side and wait again. I mean, I literally do it at 6 o'clock in the morning before the market, as the market just starts to wake up, and then I'm listening to your analysis and charts and earnings, waiting for my next opportunity. But once the market is oversold, which it will become once again, it always does. All through time, it always does. Then you can go in and just sit there and park your money. Then new money that you get, that you earn, so when I put my 300 grand back in again and I buy it 20% down, and then I earn some money next month on YouTube and I get some more wages and the market is rallied, then I can start trading again at the top. But I'll leave that money I bought at the bottom. That can sit there forever now. I can just leave that alone. But right now, it's not a long-term investing world, unless you just want to leave it for 20 years, But you make more money by trimming. The people that keep saying to me, you buy crypto and just stay there forever and hold it. Well, if you trimmed it like we said, you could have doubled your position. I mean, it was, it's not
Tripled, quadrupled, or some things. I mean, XRP on certain exchanges went down to 80 cents. Oh, we've just lost you, Martyn.
Upset with me. People were upset with me. You still got me?
You're back. Yeah, you're back.
Yeah. People are upset that I said that, but clearly it was the right thing to do, wasn't it? A lot more money was made, and and you protect your portfolio. And I know some people have said, it's all right for you. You've got 300 grand. You can make 0.5%, 1% a day and make a lot of money. I've only got 50 quid. But remember, I started with $5,000 and I started with earning nothing on YouTube. If you adopt these policies and this strategy, it becomes $300,000 over time. I mean, it's only been 4 years. You just got to keep going, doing the right thing. And no matter how little money you've got, if you do the right thing consistently over and over again over time, you will do really well. But if you try and win really big and then lose really big, it just goes to nothing. It's better to keep winning consistently. I mean, if I had not sold out a couple of days ago, if I'd left my money in, I would have made more money today. Absolutely, I would have done. But I'd already made a couple of grand, and I'm back in T-bills with safe money. All I've got to do is wait for it to pull back, and it will. There's no question. It might take a month, 2 months, 6 months, might even take a year. But when it does, I can buy much bigger and make much more money. And between now and then, I'm sitting, relaxing, sleeping. I'm on my holiday, my vacation now, not worried if the market goes down. So earning calls are really important. We learn about the businesses so we know what we can buy and invest in. We're not guessing, we're not speculating, we're not gambling. And your Electrum game show as well is a place for people to learn and understand what's going on. But it's just being an investor. There's nothing wrong with being a trader, taking some profit, but look at it as an investment long-term strategy and understand what you own. But that's all I wanted to call in and share with you. Great job. I'm learning a lot. And as you can see, the S&P now is going back down just as quick as it went up. And it's trimming back down again. So there'll be an opportunity to buy again. There's always a better time. I don't remember a time ever when it's been you missed it forever. I don't ever see that. But anyway, great job. I look forward to ASML coming up next. Taiwan Semiconductors, all these chip companies, they're the future.
Yeah, thank you so much, Martyn, for calling in. We'll get back to the show and get ready for the earnings. Thank you for calling in. It was great to see Martyn. I'm sure all the members are missing Martyn. We are all missing Martyn. So let's get ready for our next event. And as you heard, earnings are important. It's the boring things that maybe I shouldn't be finding them boring anymore. I should be like a bit more like Martyn and looking at those numbers and getting excited when we hear those numbers. I am, of course, interested in the earnings calls. That's why I cover them. I want to know the numbers. So I it's annoying when people come in as trolls and start saying that earnings are important. We know they are important. The S&P 500 is just selling off slightly as we speak. I'm going to get ready for the next earnings starting in about 10 minutes time. This show will take you directly there, so stay tuned. In 15 minutes we're going live with the ASML earnings. Again, this is all about Nvidia, semiconductors, Taiwan semiconductors, all that sort of stuff. We will get our first semiconductor earnings call this season. Remember, this will give us an indication on what Nvidia does, and Nvidia is a large part of the S&P 500 that could cause the next leg down in their earnings in a couple weeks' time. So ASML could give us an indication on where we're heading with AI and semiconductors. Stay tuned. We're going over to the ASML earnings starting in about 10 minutes' time. I'll give you the link. It is, let me give you the link. That's where we're going now. Here we go. Again, that is the link. Semiconductors. ASML investor call starting shortly. Thank you everyone for tuning in. That was Bank of America's earnings call. Until next time, there will be a couple videos up here, but take care of yourselves and each other. Bye-bye.